All right, I'm going to go ahead and get started. Appreciate everybody being on today. Had a good webinar yesterday, so we'll see if this one is better. So we typically will keep the better video, and then housekeeping, we will take all the questions and answers. We had a very robust questions, which was great yesterday. So feel free to include that in the Q&A section within Zoom. So more formally, I am Brian Klontz, president and founder of Charitable Solutions. You can see in the top right there, our 20th anniversary was last year, but I paid a graphic artist money and I'm so cheap that I'm going to continue using the 20th anniversary for this year too. So it's technically our 21st year. And we've been doing these webinars now since I think June of 2020. So COVID hit and we thought it'd be an interesting thing to do for a short term. And I think this is our 38th or 40th one. So somehow it's become tradition. So I appreciate everybody joining today to learn about crypto is Backo. Aren't a lot of things that rhyme with crypto, so I had to think about that for a while. Charitable planning with outright gifts, DAFs, and CGAs and CRTs. My joke, even though it's completely true, is I could own multiple islands if at some point I'll be smart enough to set up a hedge fund. And then that hedge fund would basically take a short position, obviously betting it will go down in value for any asset that we're going to speak about at a conference and definitely for webinars. So definitely crypto is coming back, but it was up around, I think, 74,000 on for Bitcoin. More specifically, I think dropped to 60,000 about a week after we thought, hey, this would probably be a good time to do another crypto webinar. So that happens every time, every single time. So we've got Ryan Raffin, my partner, leads our entire non-cash area with our group of attorneys on that side, and also leads more specifically our crypto activity in terms of conducting the trades, any of the planning that comes up. So he'll be walking us through. And again, this recording will be posted early next week. In addition to all of our past webinars, we have gone through the not so fun process of migrating all of our webinars and all free from our Charitable Solutions website over to a YouTube channel. So you can still access it through Charitable Solutions. We have a lot more capacity now. We were filling up our allotted memory within our Charitable Solutions website, which is a great thing. So, so with that, maybe Ryan, if you'll advance once, take a few minutes to speak briefly about the other weird things that we do at Charitable Solutions. So briefly again, since day one, our mission has been to help make charitable gifts happen that otherwise wouldn't. And we primarily work with what we say good donors wanting to do good things with good assets and being able to make sure that those gifts are captured in some way. So the 6 various services underneath are the ways that we actually do that. So top right is the emergency assistance fund activity. So I created a charity in 2012. So about, I guess that's 12 years ago, that does nothing but operate and administer, design, disaster relief, and personal hardship funds, primarily for very large employers. We have a number for charities, but we primarily work with multinationals. I think the average employee base is around 30,000. So they tend to be very, very large companies. And we then can make grants where they are tax-free to the recipient, and it is tax deductible to the donor, including the foundation or the corporation. So there's some tax risk in that and sort of process risk. We did about 175,000 grants during 1 year in COVID, so a very large team on that side. So that's the Emergency Assistance Fund activity. What we're doing bottom right today is professional advisor, nonprofit, CE. This is not CE approved, but we do a lot of the CE approval on site or through webinars. So Ryan is doing some of these now. We have Paul Kasperson, John Severson, Russ Willis. So we have a pretty large team doing those types of speeches. Then bottom middle, charitable appraisals. So we have an appraisal team. So we're talking about today, crypto appraisals and life insurance appraisals. We have Russ Willis that does termination of life income interests on the team. We have another person that does just tangible property, another person that does precious metals, and then two on the business side. So we only do charitable appraisals, whether those are estate, if needed, but more on the life income and most often on the direct major gift side. So our joke is if we can, I guess our tagline, if you can give it to a charity, we can appraise it. Did get stumped with a horse about 9 months ago. We don't do that. And then we do gift annuities. So we have two different functional areas. One is top middle around gift annuity risk management. We have actuary on staff, had one since 2003, and I do that work as well. And we really just do stress testing on primarily large gift annuity pools, usually 10 million plus, and be able to identify potential risks and optimizing cash flow, which then, of course, hopefully will maximize the residuum. So we do a fair amount in that space. More and more recently, we've been quite active and have been again since 2003 with designing reinsurance, either partial or full reinsurance on larger gift annuities relative to the pool. We got 2 or 3 going through this week, but it's been about 2 a week roughly since the beginning of the year. So more and more large gift annuities are coming in. We worked on one that was 52 million about 2 years ago. So can be quite large. National Gift Annuity Foundation, this sort of gets more into the outsourcing side of what we do. So everything sort of to the right is more hourly consulting engagement. And what's on the left here is generally more of an outsourcing model. So the National Gift Annuity Foundation I founded, which we are licensed, you can see they're in all 50 states. And we do not manage anything once it's liquid. So this is where a charity, if they don't have a pool, if they want to wind down their pool, if they don't want to go into a particular state, if for some reason it's too large for their gift acceptance, perhaps too small for their gift acceptance, perhaps too young, perhaps for illiquid gifts as an example, we then, so that the charity doesn't have to say no, we're all about not saying no, good donor, good asset when you do good things, they can refer that donor to us. I have 800 contracts. I think we're around 900 contracts now. We did about 180 last year, all of which were initially declined. The charity was then referring that over. We are the ones issuing the contract, our asset, our liability, but then you can see there 100% of the residuum is granted back to the charity or charities that the donor was trying to give to. Similarly, we do the same thing in a non-cash lane. And these are almost always outright gifts, although we're doing a lot more with CRTs. So Paul Kesperson and John Severson are leading that area a bit, but primarily outright gifts through our donor advised fund, which is the Decami Foundation. And we also have Decami Asset Trust. So same thing, donor came to a charity and they have any kind of illiquid or complex gift. Maybe it's a super quick turnaround. Maybe there are legal or tax issues. Maybe it's international. Maybe it's real estate outside their state that has tenants. For whatever reason, if the charity otherwise was going to decline that, we say, don't do that. You can refer that over. We get about 8 to 10 referrals a day, complete roughly 1 per day. And you can see there it's over 4 billion now that we have completed. 5.2 million has been the average. Last year was about 6.8 million, so a little bit larger. And you can see there the average fee was about 1.2%. We never manage anything liquid there. So as soon as there's liquidity, 30 days later, we do a full grant reconciliation, and then we make the grants back to, again, where the donor was advising, typically where they wished for that grant to go to begin with, including multiple charities and including, by the way, to other donor advised funds. So we jump to the next one. We'll sort of detail that out a bit briefly. And so this was our activity for 2023 at 1.1 billion in total donations. Again, 100% of these were initially declined. Of the 161 donations, again, if you average that, it's about 6.8 million per donation. Again, 8 out of 10 don't work out, so or 9 out of 10. So it's usually a lot of these don't work for various reasons. Got another timeshare call yesterday. Oh my God, timeshares, but. Anyway, so the 161 sort of deconstructed, you can see 41 of the 161 real estate, about 2 million each for real estate. Business interest, you see there, Very consistently, the last 5 years, 85 to 90% of what we complete are business interests, private business interests. You can see broken down between C Corp, S Corp, LLC, and other. We're talking about cryptocurrency today. So Ryan took the initiative and highlighted what we did last year. So that's 11 for 14 million. You might say, oh, 14 million is pretty good. 14 million is great. That's 14 million. Otherwise, perhaps that would not have been donated or completed, but that's about 1%, 1% of everything that we see, at least for last year. And that was pretty consistent for 2022 and 2021 as well. Cash, very briefly, we are also able through our donor advised fund to do direct investments into real estate, but much more often into private business interests or perhaps hedge funds. And so we're able to then get cash from the donor directly, or perhaps from a private foundation or another donor advised fund. Comes to our advised fund, and then we do a direct investment, which then puts us back sort of in the illiquid complex space, which is where we live anyway. About a third of our 2 billion in assets now are managed in that way, roughly. So there's a fairly large position there. That's where that cash came from. Normally, we don't deal with cash at all unless it is to do direct investments, or it may perhaps expenses or UBIT taxes, things like that, that otherwise the donor would pay. So you can see there we did some CRTs and CGAs as well in the illiquid space. The next one was, what about 2024? So we're talking about it peaking, which is the whole reason why we're on the call today. And we're like, hey, this seems timely. Crypto's kind of coming back. More donors are asking about it. So you can see there are total donations. I think this is through just the first quarter. Can't remember. And so that's 41 donations, roughly 75 million total. About 50 to 60% of our gifts, just like every other charity on this call, tend to be in the last 60 days anyway. But quite surprisingly, 9 of the 41 have been crypto, and these have been pretty large, so about 2 million per. So it's about a third. And then you can see there, in addition to that 21 million, we took in a limited partnership, we being Ryan. That was a crypto venture fund for about 6 million. So the point is, crypto all in, roughly a third of everything that we've received this year. I'll be blown away if it's not sort of 5% or less by the end of the year, but it's coming out of the blocks, crypto, crypto, crypto. So with that, I'm very pleased to pass it over to my partner, Ryan Raffin, who's led this area for a long time. And I guess I would say very briefly before we get to the agenda, we've done this a number of times. Cannot believe it's been 2 years. It's been 2 years since we talked about crypto, and that wasn't even crypto, that was NFTs. So boy, how things have changed. But you can see, most importantly, we're not going to talk about these types of things specifically, but these are all multiple free webinars. You can go on the site and say, oh, I thought they were talking about NFTs. You're not asking that question because the NFT market is pretty much dead. But you might be saying, oh, I thought this was all going to be about processing. Well, we did one that's on processing. And even though that's dated, 90% is still quite accurate. And then the donations explode really goes through the legal, the tax, and the appraisal components of that crypto as well. So Ryan will probably tease a couple of those things out, but this is much more about what the current ecosystem is, sort of what we're seeing from our perch too. And finally, Ryan did a great job updating our new 3rd edition Charitable Gifts of Non-Cash Asset book. Free download as a PDF off of our website, or if you'd like to get the hard copy, you can purchase that through Amazon. But we have one full chapter just on crypto, so that was just updated, I don't know, 90 days ago-ish, before that release. So now I will officially pass it over to Ryan to go through the agenda. So thanks.
Great. Yeah, thanks, Brian. And just to emphasize this a little bit more, we do have those past webinars. So if you're asking questions like, what is blockchain, what is staking, not going to go into that really on this webinar today. We just don't have time. Yesterday we barely got everything in an hour, and certainly don't have time to go through exactly how staking works and how that's different than proof of work. But the past webinars do cover that kind of topic, so the basics are available in past webinars, in the book as well. All of that is free, like Brian said. If there are any questions about things like that, please do feel free to drop them in the chat. We'll do our best to answer, if not live, and like I said, we may not have time. Then certainly after the webinar, like we do every month, we just collect all of the questions from the chat, or excuse me, from the Q&A, prefer not the chat. And we gather those all up and send them out to everyone who signed up for the webinar, whether it was today's or yesterday's. So everyone will see every question. So if there are any questions that are more towards the basics, feel free to either look at the other webinars, look at any of the other resources we have or that anyone else has, or just ask a question in the Q&A and we'll try to get to it. So with that in mind, the agenda today, this is probably the simplest for any of the webinars that I've ever done. I want to talk about the current landscape as things stand today over the last few months in the crypto markets more broadly, new considerations, as charities are thinking through crypto acceptance. And then finally, some lessons that we've learned over the last couple of years. Like Brian said, couldn't believe it's already been over 2 years since the last time we did any kind of monthly crypto-related webinar. We had done some speaking engagements at conferences in 2022 as well, but it was just starting to get very quiet with crypto. And that really takes me into the first slide, because where things stand today and where things have been over the last few years, it really helps provide, I think, a good grounding for this conversation and for anyone thinking about charitable giving with crypto. Current crypto market, I updated this morning again. I updated it yesterday morning. This is always the very last thing that gets updated. Anytime there is a slide deck on crypto, you always have to wait until the very last minute to update the pricing. So Bitcoin this morning, 63,000, Ethereum 3,100. Total market cap 2.3 trillion. Like Brian said, when we announced this webinar, Bitcoin was at about 73,000. So it's come down quite a bit, but still very high. That is close to previous all-time highs. If you go back 6 months, 63,000 would have been an all-time high, but it was a little bit higher a couple of weeks ago. So trading very nicely still. Same with Ethereum, and really the same with the total market cap. And you can see the graph that I have here has market cap over time. So what I've got highlighted in the red boxes here really does tell the story of the crypto markets over the last several years, starting with that late 2017 bull run. That was the first time I think a lot of charities and certainly a lot of people just in general had really heard of Bitcoin. And that was when we started to see more inquiries come in about whether we could handle gifts of cryptocurrency. That's when we started to get more serious about it. That's when we started to do more valuations, was with that first bull run. But it died off pretty quickly and went back to kind of where it was until late 2020, when you really saw a spike in the markets. And that's where we really first started to see an increase in donations, that fourth quarter of 2020, and then throughout 2021, with late 2021 being one of the all-time highs, only recently matched. But then you'll see in early 2022, it died off just as quickly. There were a lot of things going into that. Rising interest rates certainly are part of the story. The failure of Terra Labs was part of it. And then, of course, the infamous collapse of the FTX exchange later in 2022 was something that led to all of these things combined in 2022 led to what people call the crypto winter, which you can see in this graph. Pretty clearly depressed prices for much of 2022 and 2023, except there in late 2023, only about 6 months ago now, you can see the really swift upswing in prices in the fourth quarter of 2023, and which has continued into this first quarter of 2024, pulling back a little bit in the last couple of weeks, but still looking very, very good. So volatility, sharp upswings, downswings in prices, this has always been the tail of the tape with crypto, and it continues to be as it happens now. And like Brian said, The price is looking very good. And from a charitable standpoint, that does tend to drive a lot of donation activity, which we'll go into. But what is driving this latest bull run? So this is my opinion, but I think a lot of people would agree. These two items that are the major bullet points here are major factors. First, the Bitcoin ETF approval that arrived early this year in the first few days of January. I think that has really increased a lot the interest in cryptocurrency. This was a Bitcoin ETF specifically, so if you want to get a crypto ETF right now, Bitcoin is your only option. However, I think there are four major implications there. First is that you finally got some regulatory approval of cryptocurrency generally. This has been a long time coming. It took a lot of litigation to get the regulators to sign off on the Bitcoin spot ETF. On the flip side of that, of course, institutional acceptance may be just as important. You are seeing a lot of the big financial services firms getting more comfortable with crypto. Some of them are doing custody now. And these ETFs, of course, are produced by some smaller financial services firms, but some very, very large ones. BlackRock via iShares has one of these ETFs. Fidelity has one. Invesco has one. So there are some big names there. And that really helps because those two things combined lead to the third point, massive capital inflows. There is a lot of money moving into these ETFs. I think I saw that the iShares ETF yesterday was the first day where it didn't record an inflow. So, there's a lot of money moving into these, which suggests there's a lot of appetite for a spot traded Bitcoin ETF. Because of that, that means these ETFs have to acquire more Bitcoin, and that drives the price up, of course. It's a good thing. What does all of this suggest? Perhaps that there are other crypto ETFs in the future, specifically Ethereum. Bitcoin is normally about half of the total market cap, a little bit more, usually kind of 50, 55% of total crypto market cap is in Bitcoin. Ethereum is the second largest, and that's typically in the 15 to 20% range is Ethereum. They do seem to be next in line. The SEC has received some applications for approval on Ethereum ETFs, and they're working through that process now. That approval could come as soon as June, it looks like. They just delayed it a little bit, but that's underway. People are optimistic that because the Bitcoin ETF was approved, the Ethereum ETF will be next. That's driving interest in Ethereum. So you've got the two biggest players in cryptocurrency, the two biggest coins, seeing a lot of investment either directly into the coin or via the ETF. So that's driving prices up. The other thing is, and when I was drafting up this slide deck, this was in the future. Now it's already happened. The Bitcoin halving. What that means is that as Bitcoin is produced, as miners maintain the blockchain, the reward that they receive for doing so has been split in half. This has happened a few times in the past. It's intentional. It's built into the nature of Bitcoin because Bitcoin is designed to hedge against inflation by having a constrained total supply. Each time that's happened in the past, there has been an all-time high in Bitcoin's price within 12 months following the halving. So a lot of investors, I think, are feeling that there is opportunity still for some upside on the Bitcoin price within the next year. And so that has, again, driven a lot of interest when combined with the ETF approval. So that halving happened 4 or 5 days ago. I think it happened over the weekend. I was out of town, so I didn't notice when it happened. And then yesterday, someone helpfully pointed out that it had already happened. So that's what's helping, what's hurting. Brian alluded to this. NFTs, this was a hot topic a couple of years ago. Those are still around, but there's much less interest in them. You can find a lot of horror stories about people either losing their NFTs or just losing a lot of money investing in NFTs. we've gotten some inquiries about donations of NFTs. I don't think we've ever gotten one that was really, really serious. Those are not quite the hot topic they once were. 2 years ago, the IRS had not even confirmed what kind of tax treatment they got. They've since said, yeah, they do get collectible tax treatment, which is interesting because collectibles generally have to be tangible property. NFTs, of course, are not tangible. But that means that NFTs are actually getting taxed at a higher rate, that 28% collectible tax rate, which is interesting because from a tax efficiency standpoint, that makes them look a little bit better for a donation, perhaps, than something like Bitcoin or any other kind of normal long-term capital asset that's taxed at 20%. Other items that have maybe not helped with this bull run, DAOs, decentralized autonomous organizations, those have not really taken off yet. I think there's maybe room for that still, but I think those are going to end up looking more like decentralized alternatives to LLCs. We'll see. There's, I think, a lot of legislative work that has to be done to make those more viable in the future. And then staking, unfortunately, this has been something that has attracted a lot of regulatory attention. The IRS ruled that staking rewards are ordinary income. And that is something that we learned the hard way not too long ago. So I'll come back to that in the lessons learned segment. And additionally, we're seeing the regulatory crackdown both at the federal level and the state level. Federal regulators have gone after the exchanges, Coinbase and particularly Kraken, to prevent those exchanges from offering staking to their clients. Kraken is permanently barred from doing so for US clients. Coinbase has not received that ruling yet, or I think it was a settlement in Kraken's case. But the SEC has indicated that they're probably going to go after Coinbase to end the staking. And then there's 10 different states that limit or entirely prevent people within those states from staking their crypto. And that includes some high population states like California, most notably, but also Illinois and New Jersey in the mix. It's not allowed there. So that's 10 out of the 50 where state regulators don't allow staking, unfortunately. So with that in mind, why do these crypto gifts work well? The one thing that was always really appealing from a charitable planning standpoint and is still very appealing is the liquidity. Unlike real estate, unlike private stock, you can often have a non-cash donation. Bitcoin is still non-cash, that is highly, highly liquid. And that's true not just of Bitcoin, but also the top altcoins. Altcoins, I think a definition probably is useful here. Anything other than Bitcoin, technically. So Ethereum is an altcoin, even though the liquidity is nearly as good as Bitcoin. But anything that is kind of one of the top names in cryptocurrency, Solana, Cardano, there are tens of thousands of cryptocurrencies. So nearly everything by number is an altcoin, but nearly all the value, not nearly all the value, but more than half the value is in Bitcoin, and another 15, 20% in Ethereum. So the altcoins are out there. They are still very sellable, but the key is whether we're talking Bitcoin or altcoin, the charity has to be able to sell. It's that ability that's the most important thing. If you as the charity receive a donation of Bitcoin, say you get a cold wallet, a physical drive that contains the Bitcoin. You can sell the Bitcoin instantly, but if all you've got is that physical drive, how do you get that Bitcoin actually off the drive and sold and you get money? You have to be able to sell it. Normally that means working through an exchange like Coinbase. So that is really important, even with those cryptocurrencies that are a very high market cap, very high liquidity, no volume issues on trading, just being able to sell. Lower tier altcoins, those can still be very, very sellable, but I would encourage any charities considering a donation of a more obscure altcoin to do their research first and have a sales strategy planned out first. Because if you receive an altcoin, there's 20,000 different cryptocurrencies out there. If you get one that's ranked 19,000, there's probably not going to be a lot of liquidity. There's probably not going to be much volume. It's going to take a long time to sell down, even if you are able to actually sell, which you may not be able to. You want to understand that ahead of time. So it's important to understand and use a resource like CoinMarketCap, which gives information on volume, on market cap, like the name suggests. And so you can understand kind of what you're getting yourself into and what your options are for an exit, because a donation that can't be sold, it doesn't really do you as a charity much good. It doesn't advance your mission at all in any meaningful way. So the liquidity part of things, generally, that's a very positive outlook, but it does take some research. The other things that work well with these crypto gifts, very low cost to sell. If you are selling on an exchange, you're looking at something probably south of 50 basis points on the transaction, very low exchange fees in most cases. If you're using a processor, you might be looking at a higher fee, a percentage that could be 1% or maybe as high as 5%. But even those percentages, although they're higher, that's still comparable to what a real estate agent would charge, right, for a real estate sale. And no one really complains too much about that 5-6% commission that realtors are being paid. So low cost, particularly through the exchanges, but even if you're using a payment processor, which I'll talk about in a slide or two, you're still seeing a cost that's reasonably low, particularly when you take these other advantages into account, like the liquidity and the ease of transfer. That's another thing where crypto really excels. These donations can be completed sometimes in a matter of minutes. Once you've given your donor an address to send the crypto to, this is different from coin to coin, token to token. Some move very, very quickly. Some can take longer, but by longer, I just mean like an hour and a half, 2 hours to transfer. It depends on the blockchain. But that ease of transfer is really unsurpassed. I mean, even wires are not often moving quite that quickly. A wire might be able to beat a slower moving coin, but that's about the only thing. You're not going to move stock that quickly. Certainly something like real estate, private stock, that takes a lot more time, a lot more paperwork. And so cryptocurrency in these ways, high liquidity, low cost to sell, easy to get transferred over to your charity. These are things that all sound really great. And those are the reasons why those gifts can work so well sometimes. So what are some options as we're thinking through these crypto gifts? DAF giving, of course, this is what we deal with the most. This is what we see the most. But I do think donors quite like it for a couple reasons. First, since a donation to a DAF is going to be an outright gift, they're getting that fair market value deduction. So that's going to be a high value, presumably. Otherwise, they wouldn't be doing the gift. And as I've mentioned, crypto donors are very responsive to market conditions. When the markets are doing well, like they are now, that means a higher deduction for them. That means more money for your charity. And once that crypto is put inside the DAF is going to sell immediately. I don't know that there is really any other donor advised fund other than us that would even consider holding crypto inside the DAF. Maybe there are some community foundations that might do it, but every DAF's preference is going to be to sell immediately and diversify. And that's usually a good thing. That's usually what the donor wants too. They want to get rid of that volatility risk. And that is good for the charity because you're not worried about losing this gift. And the donor's happy too because they've locked in that fair market value deduction. So DAF giving can work quite well. CRTs, these have been going for several years now. I think the first one we saw must have been 2018 on an appraisal. But with charitable remainder trusts, and this is true of any non-cash asset, you really want to keep those flip provisions in there. It's not entirely clear to me whether there's a fiduciary duty for the trustee to divest the coins. I kind of think that they do have that duty because the volatility could negatively impact the interests of the charitable remainder beneficiary. I think the trustee really does have a duty to sell the coins as soon as they're able to, and then diversify. The problem is, I think, in practice that these trusts are set up so they're self-trusteed, and the donor is, they're a crypto investor. They've done well by crypto. That's why they have a charitable remainder trust, and they want to stay in crypto. So they're keeping the coins in the charitable remainder trust. I don't think that's a good idea. I think that there are really fiduciary issues with that. So I think that the coins should be sold immediately. And that's even more true with charitable gift annuities. Charitable gift annuities, if you're going to fund one with cryptocurrency, you need an immediate sale. I think deferral is a big problem with a charitable gift annuity. I mean, in theory, I guess you could write it up so that the annuity contract had a true-up provision. But not everyone agrees that the true-up provision is really even workable in general. And even if there was a true-up provision, the volatility could mean significantly lowered payments for the annuitant. That might not be a good outcome. So if you are going to fund a charitable gift annuity with crypto, I would definitely shy away from deferring. You want an immediate CGA there. And then one other thing I would note, I don't have this on the slide, I probably should have put it on there. With any kind of planned giving option that has an annuity feature, so charitable remainder annuity trust or a CGA, you're going to want to be mindful of the donor's age. One of the things with crypto, and anyone, especially the fundraisers watching this who have dealt with crypto donors before, will have noticed this. You don't have to do too many crypto gifts to notice they tend to skew young. Some of the donors that we've worked with have been in their 20s. They can be much, much younger than your average planned giving donor, and pretty significantly so. I would say there have been much more in the way of donors under 30 than over 70 for crypto that we've seen. So that does have some implications, of course, when there is an annuity feature to the planned giving instrument that you're using here. I think particularly with an annuity trust, if a donor is too young, it's a non-starter. So that's something to keep in mind. It's a practical planning tool. As far as actually accepting the crypto, and this is informed by some experience that we've had over the last couple of years here. There are a few ways that the charity can accept crypto. First would be referral to a donor advised fund for a gift and then a grant back to your charity. I think a lot of charities do like this because, as I've got in my sub bullet point there, the DAF handles it all. They not only handle the acceptance and the sale, but they're the one providing the contemporaneous written acknowledgement, the donation receipt back to the donor. They're signing the 8283. The donor is dealing with the DAF for all of that tax stuff. And you, the charity, don't have to deal with any of it. You just get a grant, probably a wire, maybe a check from the donor advised fund. And you probably get those already from other donor advised funds. So, that's really appealing. Problem is, and a lot of people watching this will realize this and be probably all too familiar with the risk here. You're assuming that you're going to get that cash from the donor advised fund. Most donor advised funds are going to want to hang on to the cash and keep it under management. I will say here, and Brian will yell at me if I don't, note that is not the Decami model. Our donor advised fund expects to make a grant of cash 30 days after receipt of funds from the sale of the asset. And with crypto, that sale is happening minutes after we receive the donation. So in our case, we're expecting to be granting that cash onward to the referring charity. But most donor advised funds, of course, do not operate that way. Another option, and I know a lot, I've spoken to a lot of charities over the last 5 years that really like this, the crypto processor. There are a couple different types of these. There are some crypto processors that really are aimed at nonprofits. Giving Block and Given are the two big names in this space. They work with a lot of charities. So those are groups that are going to help your charity accept crypto, basically by putting tools on your website and at your charity's disposal, so that you can simply send your donor basically a QR code or a link that's in essence an invoice for the donor to send the crypto to. They handle the acceptance and the sale, and then they just remit the funds to your charity instantly. That's really appealing for a lot of nonprofits. There are general payment processors that do this kind of stuff too. BitPay, I think most notably, has been doing this for a long time. There are some large donor advised funds that use them for crypto acceptance. So either way, that's going to be more of an automated tool. So a lot of charities do like that for crypto acceptance. One downside is the cost, because those processors usually are charging some kind of percentage. The other downside is that not every processor is able to accept every coin. So something you would want to check into is whether the processor can accept maybe only Bitcoin and Ethereum, and that may be all you need, so that's okay. But if they're not accepting a broad range of altcoins, that may be something that is a bit of a limitation if you have a donor who has one of those. And there's a question here. I'm glad I clicked on this right as it came in. When the crypto processors accept the gift, are they the legal recipients and provide the gift receipt, or is the charity the legal recipient? Yeah, this is where they are purely payment processors, the same way that you would have a like a credit card payment processor. The charity is the legal recipient. You, the charity, should be receiving them. I think all of the processors that I know of are for profits. They are providing a service to your charity. So you, the charity, are still the recipient. And Brian, if you know of any that are nonprofits that would be receiving the donors, jump in. But I think it's the receiving charity if you're going the crypto processor route.
Yeah, it is. It's a pure processor, but again, there can be some donor advised funds, endowment as an example, or there are other types of funds that are functioning like a pass-through DAF as an example, but from a pure processor standpoint, that's correct. They're going to be a third-party agent in that way. So the charity is still the legal owner of the processor.
And the final option, and this is the one that we know about how the DAFs work because that's what we are and what we do. But the way that we do it is via direct acceptance. So this was a question that we got yesterday was, how do we manage the acceptance? Do we use a processor? No, we accept it directly. And so I can speak in a lot of depth, more than I have time for, on what that looks like. But the thing that any charity considering accepting crypto should keep in mind is that if you are going to accept crypto directly, there is going to be significant setup work. And that's kind of twofold. If it's both the initial setup and it's kind of the ongoing maintenance, actually. So if your charity decides you want to keep the coins in a wallet, whether that's a hot wallet, meaning one on usually a computer, a digital wallet, or a cold wallet, that would be an offline wallet, a physical drive that connects to a computer, and in theory more secure because it's not internet connected. You need to get one of those. You need to get it set up. You need to have the PIN or access code stored. But that still doesn't give you, that just gives you a way to receive and to store the coins. It doesn't give you a way to sell it. you're still probably going to need to get set up with an exchange to sell. You could just accept the coins directly onto an exchange. Either way, probably to sell, you're going to need to work through an exchange. And this is where it is very different. For an individual can set up an account on Coinbase or an exchange, usually in a matter of minutes. But you're a charity, you're not an individual. That means you're going to need to set up an institutional account. That is a much more involved process. That's going to subject you to the exchange's know your customer and anti-money laundering regulations in a much more meaningful way than it would for an individual. And that is probably going to mean providing organizational documents, tax returns, bank statements, identity information about your board members and senior leadership, including things like social security numbers and passports. Some exchanges, I don't know if they're still doing this, but I remember years ago, there were exchanges that said for institutional accounts, they needed to actually have an interview with C-suite executives. It's a pretty heavy lift. And the problem is, even if you work through all of that up front, it doesn't end, because those obligations that the exchanges have is an ongoing thing. They have to make sure their customers are compliant with KYC and AML regulations. So you're going to continue to receive requests for probably a lot of the same documentation that you already provided, that ID information, that financial information. And unfortunately, this is just the reality of doing the direct acceptance. I wish I could say that it was easier. We've received multiple KYC requests from exchanges in the last 6 months. Now, that all sounds like a huge pain, and it is. What's the advantage? You as the charity have total control over accepting the coins, selling the coins, and transmitting the cash. And it can be done at a significantly lower cost in most cases than using a crypto processor, because you're only dealing with the exchange fees, which, as I mentioned, are generally 50 basis points or less. In addition, direct acceptance can allow a little more flexibility on sale if your donor is giving something that might have more volume issues or liquidity issues and might require a more customized sales strategy. The same way that if your charity receives thinly traded public stock, there's probably someone at your brokerage who can help you sell that. If you've got that institutional account, you can make a call to the exchange or email or secure encrypted messaging and work through a more bespoke solution in terms of the sales strategy. That's something that's really only going to be available if your charity is handling the direct acceptance of the crypto. So that can be a big advantage if you expect that you are going to see donations of more thinly traded altcoins. And here's where we get really to the lessons learned over the last few years. I start with testamentary gift. And I think just 10 minutes before we started this webinar, Brian was talking to an estate planning attorney about exactly this kind of thing, estate planning, which maybe some of these crypto donors never thought that they would need, but they've come into wealth maybe a lot sooner than they expected to. So things like estate planning do come up sooner, and that's why you're seeing things like charitable remainder trusts being deployed. But the testamentary bequest of cryptocurrency, I think that's not really a good idea. I don't think they're very reliable for a lot of reasons. First, you don't know when that gift is going to be realized, and the cryptocurrency could have very, very low value at that time, or maybe not even exist. There was a top 10 altcoin in early 2022 that looked very, very good. And if your charity had agreed to take $1 million bequest of that altcoin in February 2022, only 2 months later, the value would have been zero. So that to me is not really encouraging when we're talking about a testamentary gift. The other problem is, and this is true of crypto broadly, the value might still be there, but the coins might not be accessible. You really need to have the keys to access the coins. Some estimates have 20% of all Bitcoin ever mined is lost. So when we talk about that big market cap, there's a lot of Bitcoin there that's not accessible. That is a risk always with crypto. If you don't have the keys, it doesn't matter what the value is. The value could be $1 trillion. Without the keys, you are not getting to the crypto. So, and that's a problem with a testamentary gift, because your donor is not going to be around to talk to and strategize and say, hey, by chance, do you remember where you left the keys so we can get to this $1 million Bitcoin gift? You're going to have to hope that someone in the donor's family or their executor has that, and there's no guarantees, right? That's the problem with a testamentary gift, in my view. Staking, I mentioned earlier that this was one of the things that was really not driving any kind of bull run and that regulators had come down on. For a charity, there's the possibility of UBTI. This was not on our radar at all, even 6 months ago. The problem is that the IRS last summer said that staking rewards are treated as ordinary income for anyone who is staking crypto and receiving crypto as a reward for that staking. And the question was kind of, what's the tax treatment of that? Is that taxed at the time of receipt as ordinary income, or is it taxed at the time when that crypto is sold in the future? And so potentially that could be at long-term capital gains rates. The IRS said, no, it's ordinary income at the time of receipt. Unfortunately, they said that after we had already been staking some crypto for about a year. And what they did not weigh in on at all was whether something strange happened with my slide deck there. Sorry. The IRS did not weigh in on whether an exempt org who is staking crypto would be subject to UBTI on the staking rewards. So we really don't know what direction that's going to go. I've heard mixed things from accountants on that so far. I imagine eventually we're going to get some feedback on that, but like with NFTs, the IRS can be slow to respond on crypto. So it could take a while before they answer that question, particularly because the question of whether an exempt org doing staking is taxable on the rewards, that seems pretty obscure, but obviously relevant for us. And for any charity, if you've got a donor who says, I really want you to hold on to these tokens, and if you're going to hold them, by the way, why don't you stake them so that so you have more tokens and the value in theory goes up. You may want to think twice, because there may be some UBTI in the mix when you're doing that. Next point there, improper security and controls. This is always true with crypto. If your charity is going to accept crypto, you have to have very good controls in place. First, because there's still fraud, and there's that risk of loss of tokens. Like with the testamentary gift, same thing. If you, the charity, lose your keys, you lose the access to your exchange account, that's very scary. And so just simple negligence could result in a loss of significant assets when we're talking about crypto. One thing that we have done, and which I think is for any organization that's going to be taking crypto, you really want to have requirements from multiple trusted people within the organization to sign off on any crypto transactions. So that means transfer of any tokens, sale of any tokens, moving any cash, initiating any wires within an exchange account. You want to have multiple approvals required, and certainly also multiple approvals required to change any of the account settings. That's really, really important for a charity if you're thinking about accepting crypto yourself and doing that kind of direct acceptance. The next mistake, and this one I have seen many times in many different forums, and I have a few of my choice quotes here. Not understanding donor expectations. That can be, oh, I didn't realize you were going to sell immediately. I thought you were going to hold the tokens in my donor advised fund. No, I thought I communicated that clearly. Evidently not. Another one, because crypto markets run 24 hours a day, the donor being upset because the price looked very good very late at night. That is surprisingly common with crypto investors. They can keep odd hours and they keep an eye on what their coins are worth. And I have gotten texts at 11 p.m. saying, hey, price looks good, want to donate now. Not great unless you have someone on your team who can handle the crypto and is really a night owl. Finally, your costs for selling are too high. Crypto donors can be very, very fee averse. I have had donors on multi-million-dollar transactions complain about $10,000 fees. Getting asked about what the exchange fees are is a reasonably common question. Even though it's 50 basis points, the crypto donors often want it to be 5 basis points or ideally 0. Because the idea with crypto at its inception was that this would all be frictionless, I think there's a real resistance kind of baked into the philosophy of cryptocurrency to any kind of fees. So costs for selling can be a sticking point with donors. And it's really important to just set these expectations from the outset. And then generally, this is the final point, and this is something that Brian always tries to emphasize, and rightly so. Don't spend a lot of time getting set up to accept coins that are not sellable or to accept gifts from donors that may not even exist. If you have a donor who has a great coin and they're ready to go, that's when you want to pull the trigger on figuring out how you're going to accept and sell the crypto, but doing it in anticipation of these donors somehow materializing and you don't actually know if they're out there. That's not a great idea because there can be a lot of work in the setup, as I've mentioned. And it's good to think about this stuff, but it's probably not worth putting in front of your board unless you really do have someone ready to go with a token or coin for donation. And we're running out of time here, so I'll go quickly. Brian, was there something you wanted to add there?
I was just going to say exactly what you said. The build it, they will come model does not work well in this space at all. Minimum, we get 30 to 35, and that's actually dropped in a good way. Inquiries from donors or charities about giving crypto for every one that actually does it. So you'll hear lots of noise. Oh my gosh, we had 7 people ask about it. We better have 35 people asking you about it to do one. So just to Ryan's point, just be a little careful. Meanwhile, you set the whole thing up. It usually takes 6 to 9 months. You get everything approved. You're all excited. You get one in if you're lucky for, $2,000. You're already super backwards. And then nothing happens for 6 months because it goes into the sort of cold period. And then you have to still do KYC, as Ryan was mentioning. So now you got a whole new set of board members. And then what do you mean you're even personally identifying information to some random email? So that's happening with a lot of charities right now. So you just have to have the volume to make it worth it. And you can use a processor or an outside outsourced party until you sort of get the volume. Like, wait a minute, we're doing like, 2 or 3 of these a month. You won't be, but let's just say that you are. And you're like, okay, now let's set up our more internal process or a different provider to do that.
Yeah, exactly right. And yeah, we got a couple minutes left here, so I've got 2 more slides. I'll go very quickly on this one. 8283 still required by the IRS for cryptocurrency donations. It doesn't matter that exchanges have publicly posted prices and they look like stock exchanges. IRS does not care. They want the 8283. They want that qualified appraisal. Crypto exchanges are not securities exchanges. However, these crypto ETFs, those are publicly traded securities. 8283 would still be required since it's a non-cash donation, but it's going to be exempt from that qualified appraisal requirement. So crypto ETFs maybe look pretty good in that regard. And because it's a publicly traded security, you avoid all this crypto acceptance discussion. You're just dealing with your broker the same way you would for any other publicly traded stock. So crypto ETFs might look pretty good in a year or more once the donors have held those for 12 months, have long-term capital gains, and hopefully the price has gone way up. So those could be a good, simple option in the future. And then the final slide, just an alternative crypto donation. This was mentioned on the 2024 activity, and we've done a few of these crypto venture funds. There are venture capital funds out there who are setting up partnerships, getting investors, and having the entire fund invested in startup crypto tokens. those donations can work, and it's kind of a different way to do crypto, because instead of receiving the crypto in your charity, you're getting a limited partnership interest. One thing I'd say is if your charity does not accept limited partnership interests already, you're probably not going to want to start doing this, because all of the things for normal limited partnership donations that make those complex are still in play, and it's a very different conversation than a donation of crypto. You're going to get a K1. You could have UBIT. You don't have any control over when you get cash, because the general partner controls that in the fund. And they control whether the donation can even happen at all. All the normal transfer restrictions apply. And with venture capital, that normally means what the managing fund says goes. If your donor is just a small passive investor in the fund, they may not have the level of influence needed with the general partner, with the venture capital fund, to get the donation approved. It's very unlikely that a charity is pre-approved to receive this kind of transfer in the venture capital fund's governing documents. So that's something that it can work very, very well, but it is an LP donation. It is going to be the normal LP conversation, which is very different than the crypto conversation that I think we've now just concluded a minute over time. So thank you, everyone.
Great job. Let me go one more slide. So just to close, great job, Ryan, in a huge way. I hope this has been helpful to everyone on the call. These are all of our past webinars. Again, 2 or 3 of these, I guess 3 have been on crypto as well. So feel free to look at those resources as well as the book. But I hope this, again, is helpful, arms you now to be able to speak intelligently about what's happening in the crypto market for both DAFs, outright gifts, life income gifts, as well as potential estate gifts, although they get super tricky, as Ryan mentioned. So thank you so much, Ryan, and thank everybody for your time, and good luck.
Great. Thank you all.